September 2008. Lehman Brothers, a 158-year-old pillar of Wall Street, collapsed in a single night. $600 billion evaporated, triggering an immediate institutional panic. This institutional panic shared a single common ancestor, the ubiquitous marketing slogan, "Why rent when you can own?" By 2002, the American home had transitioned from a place to live into a mass-marketed financial asset. The timing of this housing boom was highly specific. In 2001, the United States economy was reeling. The dot-com bubble had just burst, wiping out tech fortunes, and the September 11th attacks delivered a massive psychological and economic shock to the country. The Federal Reserve needed a way to jumpstart this stalled economy, so they slashed interest rates to practically zero. Suddenly, borrowing money was incredibly cheap, and credit flowed freely. This sudden flood of cheap cash transformed the housing market into a national obsession. Houses became speculative lottery tickets, with millions of buyers rushing into the market and unwittingly wiring the fuse for a global economic disaster. To keep the housing boom moving, lenders needed new buyers, so they pushed the subprime mortgage. Subprime refers to loans intentionally given to borrowers with bad credit histories or highly unstable incomes. Traditional lending rules were abandoned. Down payments became optional. Brokers even pushed ninja loans, an acronym for no income, no job, no assets. If you had a pulse, you qualified for a mortgage. Lenders ignored the obvious risk because they believed housing prices would always go up. Their logic was simple. If a homeowner defaulted, the bank could just take the house back and sell it for an even higher price. The entire mid-2000s economy was balancing on a doomed foundation. The booming market relied entirely on massive debts held by people who lacked the basic means to repay them. Your local bank rarely kept these risky loans. As soon as the paperwork was signed, they sold your mortgage off to major investment firms on Wall Street. Wall Street took thousands of risky mortgages and bundled them together into packages called mortgage-backed securities. To sell this debt, they paid ratings agencies to evaluate them. The agencies slapped an AAA rating on the packages, presenting the toxic loans as perfectly safe. A handful of skeptical investors read the fine print and saw the garbage hidden inside these highly rated bundles. They went to Wall Street and asked to buy credit default swaps, insurance contracts that would pay out if the housing market crashed. The big banks gladly sold this insurance. They collected the monthly premiums with zero concern, blinded by an absolute belief that housing prices would never fall. Through this financial alchemy, high-risk consumer debt was laundered into globally traded investments. Without realizing it, the entire financial system had wired a massive explosive device directly into its core. By 2007, the supply of new houses finally outpaced demand and prices stalled. Simultaneously, the introductory interest rates on millions of subprime loans reset to much higher payments, triggering mass defaults and foreclosures across the country. Because those supposedly safe AAA-rated Wall Street bundles were built entirely on the backs of failing consumer mortgages, the value of the massive investment packages instantly turned to dust. Pure panic quickly swept through the banks. Institutions holding supposedly secure, profitable assets suddenly realized their vaults were stuffed with radioactive debt that no one in the world would buy. The weight of these toxic assets was too much to carry. When Lehman Brothers completely collapsed under billions of dollars in losses, it proved that absolutely no financial institution was safe. The sudden death of a major investment bank shattered all trust. Banks stopped lending money to each other entirely, completely freezing the flow of credit worldwide. The credit freeze quickly spread past the trading floors. Ordinary businesses couldn't get cash to make payroll. Retirement accounts evaporated in real time, and global commerce slammed into a brick wall. The U.S. government faced a brutal choice. They could let the reckless banks fail and guarantee a worldwide economic depression, or they could take taxpayer money and rescue the very people who lit the fire. They chose the rescue. The government launched the Troubled Asset Relief Program, or TARP. They handed out a $700 billion lifeline directly to failing banks and massive insurance companies like AIG. Meanwhile, Federal Reserve Chairman Ben Bernanke deployed a strategy called quantitative easing. The Fed essentially printed new money out of thin air to buy up the toxic mortgage assets and flush the banks with cash. Injecting trillions of dollars into the system worked to unfreeze the credit markets and save Wall Street from ruin. But it served only as a patch for the banks, leaving the underlying damage to the public unhealed. Almost immediately, Wall Street banks returned to profitability, and executives resumed collecting massive bonuses. On Main Street, unemployment spiked to 10% as millions lost their jobs and their homes. $19 trillion in household wealth was wiped out. Countless families who had never missed a payment woke up to find they owed more on their mortgages than the market value of their houses. Despite the massive scale of the fraud, the system protected the powerful. Not a single major Wall Street CEO went to jail for their role in the crash. Instead, they walked away with quiet retirements and golden parachutes. This glaring double standard ignited severe cultural rage. By 2011, protesters formed the Occupy Wall Street movement, driven by the stark reality that corporate profits were kept private, while corporate losses were paid for by the public. The 2008 crisis wiped out a booming global economy and disrupted an entire generation's trust in the financial system. That deep resentment still shapes our world today.